Okay. These young kids know all this stuff. Jeez. Okay. So if I've got my slides up and we're doing recording, we're going into the last module of the 6-module course. Each one has these slides, but every time I do it, I'll be covering different areas, like I mentioned. This book, Active Retirement Investing, has, I think, 275 pages. It's your work manual, so we want you to read through the book at least once all the way through. The old pitch is, whether you're doing your own investing and you want to know this stuff so you don't make mistakes, that's very important, although this is educational, no guarantees, but it does give us a process. Or you have a family member or an advisor helping you. We want you to be able to look at him or her and see what they're doing and see if it feels right. Make sure either a naive family member is not getting drawn into a mistake, or a professional advisor is maybe misleading or maybe not as experienced as we want. And of course, we want to avoid salespeople that are selling us things. The problem with paying a commission for something is you might pay 4% commission up front, or hidden fees. And they're not hidden because they're in the prospectus, but you're paying fees over the years where this person gets paid up front and then you never see them again. So we're going to teach you how to do it yourself, or if you have a family member or advisor help you, look at the back of the book and see what they should or shouldn't be doing. And then I'll bring this up in this outline. Definitely check their background. You can go online, brokercheck.org, and check any professional that you might be working with and make sure that they don't have a bad record. I watch American Greed all the time, one of these cable shows, and it's amazing how many times the people that got taken advantage of, had they just done a background check on the bad guy or bad girl, they could have at least found out. So let's go into the slide presentation. This is section 3 of the book. And it's phase 3, section 3, where we're doing portfolio and estate planning monitoring. So once you've looked through all the diagnostics and cleaned up your cash flow, your insurance, your taxes, and estate planning, and looked at old investments and determined whether to sell them and buy new ones. And if it's in a retirement plan, you shouldn't have any tax consequences. Outside of a retirement plan, you've done your planning. But if you've got a lot of gain in something and you want to get rid of it, I wouldn't be afraid to get rid of it, even though you pay taxes, because you're going to pay them at some point. And if you could sell that item now, pay the taxes, taxes might go up in the future. It may give you an opportunity to be reallocated appropriately. And the only downside to doing that is, if you're planning to die anytime soon, your beneficiaries miss out on a stepped up in basis because you sold something, paid the taxes. So that's a personal issue. It's a personal financial planning issue. And look at those diagnostics and get a feeling for how you can manage your own financial planning, unless you hire somebody. Then section 2, we talked about which investments. We prefer exchange traded mutual funds because you can get in and out throughout the day. You have a little better idea of what price you got. You don't have to wait till the end of the day to get in or out, which you would on a managed fund with some mutual fund company. And those same companies are creating exchange traded mutual funds representing or mirroring their old mutual funds. So that's great. If you like any particular companies, you can probably work with them in the form of an exchange traded mutual fund that you can buy and sell throughout the day. So that was section 2. We looked at which funds to pick, or get some idea of what the funds are created like, whether it's an index fund, a passively managed exchange traded fund, or a managed mutual fund. Then we showed you some ideas of how to create a portfolio and how it's going to affect the ongoing volatility and risk. That's a complete, absolute unknown for the future. I can't tell you that if you have this kind of stock and the stock market goes down 20%, that it'll drop 20. It might drop less, or it might drop more. But some of the calculations that we follow give us some idea. So section 2 was finding the investments, matching them up to your objective and expense ratio and all of that, and then showing you what a portfolio looks like. Section 3 is, what do we do now? Because if I'm a financial advisor, I work with my clients, once I'm done with a financial plan, you can revisit it once a year, but you're done. Then once I've allocated the portfolios, I'm pretty much done. And we talked a little bit about rebalancing. Very good technique, but it's, in my opinion, overused and done at times where it doesn't help clients if we don't find out exactly what their needs are. So section 3 is, what do we do now? You as an individual advisor doing things yourself, you need to know all the details that I'm going to skim over today, because we're going to go to a Morningstar and look at a variety of portfolios and see what they look like and give you some ideas of going out on your own and recreating your own portfolio, or talking to an advisor or a family member. Phase 3, portfolio monitoring and estate planning. The account may be registered as a rollover IRA. It might be registered as a regular IRA. It might be a Roth IRA, or it might be a non-qualified account. What does non-qualified mean? In my view, non-qualified is something that didn't qualify for a deduction when you put it in. So a retirement plan, rollover, or TSP that's still there, 401k back at the old company, those are qualified plans. They qualify to be deducted with dollars going in, accumulate tax deferred, and they'll be taxable someday. And when you hear all these ads about, I'm going to teach you how to live a tax-free retirement, well, that's not without a price. You can roll your 401k to a rollover IRA, then you can convert it all to a Roth IRA. And from that point forward, your money will grow tax-free. But the hit that you took to go from a rollover IRA to a Roth is huge. You need to talk to a financial advisor or a tax person and plan out how you're going to do that, because you could get a massive tax bill in the year that you do that. But a lot of these insurance people sell the concept of living tax-free, but there's a price to pay unless you never had a retirement plan, but all you did was buy a Roth. And obviously Roths are fairly new for most of us. So you'll look at your registration to monitor your accounts. This is what we do for clients. I'll find a client that has an account in joint tenancy, but we know they set up a trust. So we need to remind them, are you sure you want this in joint tenancy? It's not the most tax efficient way to own it. You have a trust. Should we convert it to the trust? And they may or may not. A lot of things go behind just doing this stuff. So you'll need to know what the registration is. Throughout the process, your needs and circumstances will change. So if you decide that I'm 88 years old and I never did need all this money, I'm going to keep it. So when I die, my kids get the money tax-free in a stepped up basis, not in retirement plans, but I'm going to reallocate it a little bit more. I'm going to take more of my cash and bonds. So when I sell them, it's not going to hurt me tax-wise for the most part. I'm going to start buying more stocks. What? I'm 88 years old. What are you doing? Well, I've realized that my retirement, my Social Security, my house is paid for. I don't need this money. I'm going to start reallocating it for, let's say, my adult children who might be 50 or 60 years old, and their retirement is not maybe as strong as mine was. So your needs may change. You might want to get more aggressive for that reason, or you only have your rollover 401k that's now a rollover IRA, and you're scared at night hearing about the news of everything that's going on. So then maybe you do reallocate into more conservative items. The dilemma today is inflation is said to be at 7.5%, 8%. And interest rates are almost nothing. So where on earth do you go? If you rush to the bank to avoid the volatility of the stock market, inflation will get you. If you run from the bank to the stock market to grow with inflation, then a stock market crisis will get you. So it's kind of like you're between a rock and a hard place. We talked about having short-term money, intermediate and long-term. They're all liquid at any time, but the horizon is the short-term stuff. I don't expect any return. Yes, it is going to erode to inflation. The intermediate term bucket is half going to erode, half's going to grow. So maybe I break even in a couple of years if there's volatility, or maybe I grow a little bit to keep up with half of inflation. And then the third bucket is I'm committed to these dollars for 10 years or more. I don't care what the market does. I'm going to stay invested in a bucket of stocks. You could change from one stock to another, but you keep your foot to the fire, foot to the pedal, feet to the fire, and stay invested. And that third bucket is, what if I live way too long, inflation goes up too much, or I die early? I want to leave the grandkids or the kids something that had more growth potential. The other thing is I might need to be more aggressive when others need to be more conservative, or vice versa, same thing. Something in your life may have created a seismic shift. So you may become more conservative because you're scared about what you hear in the world and you're willing to see your buying power go down with inflation. Or maybe you had a few real estate properties you sold that you carried the note for 10 years, but now they're expiring and you've been paid principal and interest. That money's gone. So now you need to reallocate your portfolio. The point I'm making is walking into a big financial company and saying, I want you to manage my money. I don't have the time or the interest. They go, great, let's put you in bucket A or B or C or D. The problem is you're getting in with other people and they're going to manage it the same way for everybody. If the market and stocks go up, they're going to sell some off and buy bonds. Well, what if they did that recently when the market was up? They sold some stocks and they bought bonds. Well, unless it's short-term bonds and you're keeping your powder dry, those short-term bonds could get lose inflation growth, but they're going to be more stable. But the long-term bonds this other company bought could have dropped considerably if interest rates go up. So if I go into the same managed portfolio that these big institutions do for thousands of other people, and it just rebalances automatically, that may not be to my best interest. With my clients, I was rebalancing from intermediate term bond funds into ultra short and short term 6 months ago or a year ago, just because we worried about inflation and interest rates going up. Okay, next. Once you've got your allocations created, your portfolios, whether it be one big one or three, one being cash, one being balance, and one being long-term, we need to keep an eye on everything on this schedule. So if you're doing this, you're always going to have something to do. So take a look at this very closely, and it's on page 183. Here's what you need to take over if you don't want to hire somebody to do it for you. Because if you do it yourself, you save yourself 1% a year, and in the long term, that adds up. However, if it takes up all your time and your quality of life declines or you make mistakes, then that's not worth it. So there's a variety of things that we do on a daily basis that we pay for. So let's see whether or not we want to pay for somebody else to do it or hire a family member to do it. Here's the things that you need to look at in the portfolio itself. Daily, we want to monitor what's going on in the political news and with the Fed. Well, we know, and I knew 3 years ago, but more recently, this Fed said they were going to raise interest rates because we hit rock bottom. So because we knew that was coming, let's move out of any long-term and intermediate-term bond funds and get into ultra short and short-term. And that's been very wise because the longer-term bonds have dropped as much as 12% in the last several months. The short-term bond funds that we have clients in are down 0.25%, maybe a half. One of them's 3% more than we prefer, but 3% is a lot better than 6 to 12. So we want to manage that kind of risk. And you can do that by watching the news every day and seeing the feeling of what interest rates are doing. It's not a guaranteed way of predicting, but you can get a pretty good idea of if interest rates go up, bonds will drop, and most likely the stock market will adjust downward. And so you could move to cash, or you could move intermediate term bond funds to ultra short term bond funds. You can move out of the high dividend stock funds if you don't want them to drop, because they will, or you can decide to hold them and be aware that the price could drop, and maybe you'll move some money back in after that happens. Weekly, we want to monitor the funds. Find an app on your phone. Morningstar sends me little notices on what are called fund alerts. Did a manager, if it's a managed fund, just leave the fund? A lot of them are retiring, so new management come in. Maybe you have a managed fund that you think is really great, but new people are taking over. Or it's an index fund that is being forced to sell something and buy more of something else. And you might get a notice of that. Vanguard actually triggered a problem with one of their lifestyle funds, is that it used to be that you had to put in, let's say, I'm guessing $100,000 to be in it. And then they opened it up to small investors. Well, now all of a sudden, there's a lot of money coming into the fund. They're having to buy new stocks at higher prices, and that has an effect. So we want to know what's happening. Or one of your funds, did they raise or drop the expense ratio? Are they doing something? Did they get fined by the SEC? So daily, we want to see what's happening with politics and interest rates. Weekly, we want to know the inside scuttlebutt of what's going on, good or bad. Monthly, we want to shop for new funds. Now, this is critical also, each of these. If you've got some old managed mutual funds that have expense ratios of a half, 3/4, 1%, well, unless they're giving you something very special in return, it's time to get out of those and look for lower cost funds. There are exchange traded mutual funds that I keep mentioning that probably do something very similar, but at a lower cost. There's actually some of these large mutual fund companies that are known for managed funds, and they always said managed funds are better. Well, they only said it because they could charge quite a bit more for it. But now the wave is moving towards exchange traded funds that have lower cost. So these big old staunchy mutual funds are now converting their funds and or coming up with new exchange traded funds so they don't lose the market. So we want to be shopping every month to look for new exchange traded mutual funds that we could buy with new money or shift out of old money, but make sure the taxes don't hurt you too bad. We look for these new funds that have lower expenses. That would be nice. Even a managed fund. I think there's a Fidelity Magellan fund or something out there. I will only assume that its expense ratio is lower than the actual old mutual fund. So you can find some of your old mutual funds that you really liked in the form of an exchange traded mutual fund, either now or sometime in the future. So you want to keep an eye on that. I have one managed preferred stock fund that is down half as much as the index, but its expense ratio is 0.80. Well, I'm getting something in return because it didn't drop as much as the index. So that higher expense ratio really helped out. But it is a high expense. I'm looking for a lower cost exchange traded mutual fund, not just an old regular mutual fund, to replace it. But I haven't seen any that have performed as well on the downside. So I'm just saying, you go shopping on a monthly basis. There's new unique structures, different types of exchange traded mutual funds. The management is different, or if they're non-managed, maybe they're super big and their expense ratio is quite low. So remember the vertical pyramid that we had going on. The base of the pyramid was made up of total market index funds that are super cheap. The middle part of the pyramid was made up of passively managed or allocated index funds, still really cheap expense ratio. And then the top of the pyramid was just a handful of high cost managed funds, but they gave you something in return that you couldn't find in an index or a passively managed fund. So daily, weekly, monthly. Quarterly, we need to review the funds that you already have and see how they're doing. So review and monitor existing funds' performance. Are they following in the trend that you think they should? Expenses. Are they too high for what you're getting? How is their ranking? And then the management manager tenure, is it been around long enough that you have they lost a manager? And as well, how are the holdings? So performance, I have probably 4 different preferred stock mutual funds and exchange traded funds, one of which wasn't one that protected us on the downside. I tried it, had a higher yield. I'm real disappointed. It's down 12%. Yikes. Whereas the other one I paid a really high expense ratio is only down 6. Or some of the others that are known to be shorter term assets aren't down as much. So I'm disappointed with that. So when I see it on a quarterly basis, I might hold on to it longer to let it reinvest its dividends at a lower price. But I wish I didn't have that position, and that higher cost fund might have been better. But ultimately, we just want to deal with funds that have the lowest expense ratio possibly. Biannual basis, after we reviewed quarterly and scanned our funds to see if there's any that we think we want to get rid of, biannually, similar thing, but not for poor performance. Biannually, we want to monitor a substantial increase in value. So I personally had a few energy funds I sold off yesterday, and this time we got lucky because the price dropped right after that, but don't count on luck, and please don't think you can time the market. But it is a human reaction to run back and see what you sold something for and what it's worth today, or what you paid for it and did it go up. That's human nature. But what we're doing is more of a methodical strategy to be investing. And biannually, we're looking for the funds that are up too much. If you have an energy fund, it's up a lot. Is this time to sell it? I don't know, but it might be time to sell a fourth of it or 10% just to take some share prices that are peaked out at the top. Obviously, we doubt that the prices will stay as high as they are for energy, but at some point, one might decide to sell. Other areas that were up a lot a few months ago were technology, but we never really know when to sell. So on a biannual basis, if you take some area of the economy, utilities, technology, energy, healthcare, real estate, if you have a fund in that area or one that has a lot of concentration in that area and it's up a lot, then you might consider twice a year look at it and say, look, I need to give some back. I'm going to sell a fourth or a half, and then I'm going to go buy into the funds that I own that are down through no fault of their own, whatever that is. So you rebalance things and sell from those who have, meaning the funds that have appreciated much more than what is normal, and give to those who have not. And those are the funds that are down. So biannually, we're getting rid of some of our excessive gains. Quarterly, we're getting rid of funds that don't match our objective or have been underperformers for reasons that they've caused, that we believe. Annually, we want to update changes to your current needs. Has your income need gone up or down? It might go down if all of a sudden you sold a rental and you're taking payments over 10 years. Now your income's higher. Spreading out your capital gains, that helps. Although your beneficiaries would benefit more if you just died, right? They get a stepped up in basis. You may have started Social Security at age 70, so your income is higher. So those are obviously indications that you have more. But like I mentioned before, what if a note on a property expired and you don't have that income? Maybe you need more income. So annually, you need to reevaluate the diagnostics. Do I need all this insurance or not? Should I get more in a certain area? It's a little late for life insurance and long-term care. It's pretty expensive. Anybody that has a military background, check the VA and see if when you were in service, do you qualify for long-term care through the VA or not? But it's a resource worth checking into. So we review the diagnostics, check all the financial planning stuff and the estate planning. And then we look at the overall need for cash flow and look at your portfolios and see if they're still up to the allocation that you feel comfortable with. Things are going to change once you've invested in anything more than cash. And cash, you don't see it change, but invisibly it's shrinking in buying power. It's very comfortable to go and have CDs guaranteed by the Treasury or the government and not see it lose any money at all. But with inflation being such a problem right now, you're not buying as much. I mean, you can tell me all the products that you're buying that are outrageous. I'm trying to go more battery. So I have a bunch of battery tools at home, and I bought batteries for like $80, big massive battery for my drill and the saw and all that stuff. Now I bought another one because I left one out in the rain and got wet and died. Now the new battery wasn't $80, it was $230. So that's inflation. And my cash sits at the bank, very safe, secure, but it doesn't buy as much. And so we need to have some monies invested for inflation long-term, but we also need some short-term problems that can be solved with cash at that point. So we know that we need to do something daily, weekly, quarterly, biannually, and annually, right? If I got them all. There's a lot of work to do. We need to monitor and manage the security of your accounts. That's a big deal, and especially with everybody concerned about what Russia might be doing. You already know this, but you should be having sign on to your accounts that then they send you a password on your phone, and then you put that back in and they let you in the account. That's I think it's a 2-stage authentication, and sometimes there's 3. So I would go to YouTube and watch some videos on how to secure your accounts more. But if you work with an institution, they have to make sure that your information is secure and make sure that they do everything possible to avoid fraudulent transfers and computer hacking. We take classes and courses to try to avoid that. If you contact your institution or your advisor, by email and say, hey, sell this and send it here. It's not going to happen. They're not going to take an email or a text and send money to some unknown outside source. They're going to have to hear your voice and have a form signed by you that you can do that in the future, because there's been a lot of ripoffs that way. So we're required to be very cautious for you. You'll need to manage allocations of the funds to be used for RMDs, required minimum distributions. If you're 70 or 72, you're going to don't have to at 70, but you may have already started doing mandatory distributions. That's fine. But if you have a diversified portfolio, do we sell out of all the bonds and keep paying out of the bond funds because the stock market's down when you want your distributions? But at the end of the day, you may have sold off all the bond funds that were not down or not down very much. And now you've got 100% stock accounts. So you need to watch that. In an average balance market, you might sell a balance fund that has half stocks, half bonds. When the stock market's down, sure, you could sell off some of the bond funds, but you've got to start selling some stock funds if you want to balance it out. Or you could live off the bonds for 5 or 6 or 7 or 8 years and give the stocks time to recover if they do. So there's a lot of strategies to liquidate from your retirement plans, and they're covered in the book. But take a look at page 185. I get notices from Amy in the office. She'll say, so-and-so's ready to do a once a year distribution. What do you want to sell? Then I'll look at the account and determine which funds to sell some out of. And at this time of year, the stock market's down about 13% overall. But if you have an S&P 500, let's say high dividend, low volatility fund, it might be up 1.5%, 2%. Now, it doesn't mean that that fund and manager is so wonderful. It's just that he or she bought the stocks that had less volatility. They were old, staunchy stocks that don't have a lot of upside growth. They pay out all their earnings and dividends, and they just happen to have not dropped much recently because interest rates going up cause long-term stocks to drop more because the investors aren't going to get their dividends for quite a long time. And interest rates going up cause long-term bonds to drop. So you may have an S&P 500 low volatility, high dividend fund that you don't see a loss in. And when it's time to liquidate some money, let's liquidate part of that because you're not down, and a little bonds to balance this out. I'm just saying it's a possibility that things are going to go wild on you. But if you've got some cash and bonds in there, that buys you time, but you might have some other funds that might not be down. Very rare right now. Process any regular or occasional cash distributions. If you need money out of your account, and I'm referring more to the rollover IRA, the big accounts. In a non-IRA, you have to consider taxes. In a regular IRA, it's all taxable. So what you sell doesn't really matter, but whatever comes out of that IRA is going to be fully taxable. If it's a non-taxable account, determine what the tax implications might be. But again, you don't go broke taking your profits. I wouldn't let the tax tail wag the dog, because if you don't sell the stocks because they're up and you just sell the bonds, things could get really ugly in the next 5 years, and you might have kicked yourself for that decision. Update registrations on non-retirement accounts to a new trust. If you have a new trust or you've changed the name, if you have an old trust, you usually can re-register it or do a new trust in a same name. So that could be available for you to restate the trust in the same name, not have to change it, but make a lot of changes. Attorneys are going to want to do the same price. So update individual accounts if it's appropriate to go in the name of the trust. And then if you've changed the trust altogether, if the name has changed, we need to update that. Examples of other account registrations: individual, joint tenancy, all these things. Community property gives couples a better tax benefit with step up in basis, transfer upon death. There's pros and cons about most of these. But if you have a partner and you're legally married, community property is beneficial for taxes on non-retirement accounts. Confirm and update the beneficiaries. Who's your beneficiaries? Have they changed? Has somebody died, or you want to make a change to them? Take a look at all your accounts. I I had a client who we've sent forms to change her beneficiary to her husband many times over the last 20 years. She never sent them back in, passed away, and the sister is the beneficiary, not the husband. So now the husband has to be real nice and get the sister to sign off and let him be the beneficiary. And he thinks that he'll be able to do that. But if you don't update these things, beneficiary provisions go over a trust. And so we could make a mistake if we don't check on those. Distributions of beneficiary accounts. So you need to know a little bit more how those are set up. So if you leave your IRA to a beneficiary, they can keep it as a beneficiary IRA, but they have to start taking distributions if you were, or they have to pull the money out within 10 years, all that stuff. And one great place to learn all this, if you want to go deeper, is just go to YouTube and look up the subject, and there'll be qualified and non-qualified people giving you their opinion. I wouldn't take their specific advice, but use YouTube just as an educational tool. It's a great way to get things in conversation. Are you setting up 529 plans? Do you make student loans? Things like that on an ongoing basis. Our grandkids might be old enough to go to college by now. Stay on top of tax information. If you have an advisor or a family member doing this, or if you're doing it, you need to stay on top of the current tax codes. Well, how do you do that? I go to YouTube on Saturday mornings. I bring my little maple syrup, and I get one of those little egg white things, and I get orange juice, and it's like having pancakes, but it's not as fattening. And I'll sit there for a couple hours and watch a bunch of YouTube videos about current tax law, about current estate planning law, and some about the investment stuff, but I do that all week. But I want to learn all the areas that I'm not up to date with on a regular basis. I don't give legal advice, but it's important for me to know how these accounts should be registered, so I can share that information with my staff, and we can pass that on to the client. So if you're going to do this, take a couple hours a week to go to YouTube or any other instructional videos and learn about current tax law, current estate planning techniques and ideas. And the investments, yes, keep up on that, but we can't predict what the investments will do in the future, but we can predict how the next tax law change might affect your distributions. We can say that if your estate planning documents aren't in place or updated, we can predict there could be a problem based on current estate planning law. Setting up new accounts. Obviously, if you're doing that, it's like pulling your hair out. Last time I called one of the big investment companies, they didn't answer for like 30 minutes. So I leave that to my staff, but you want to stay up on that. Or if you have the ability to set up new accounts, be patient and maybe watch a video on that. And that same company might give you a video on how to set up a Charles Schwab brokerage account, how to set up a Fidelity brokerage account, how to set up a TD Ameritrade, a National Financial, all those different things. They might help you if you absolutely don't want somebody else doing it. Little tidbits: we should avoid rolling over an IRA where funds come from a large company into or with your little side IRA that you did a little bit each year. The rollover IRA gives you liability protection in a lawsuit. Your little IRA on the side may not. If you combine them, the big IRA could lose its asset protection in lawsuits. So something that is important to take a look at. Advisors, if you have one, he or she should verify where your investment money comes from. So if you go in to see somebody, the bank or an investment advisor, they need to know where the money came from. So spare yourself the frustration and anguish and being angry at the person at the window. They have to know where it comes from. And then if you liquidate old investments, they need to check on the potential capital gains. So if you have an advisor now, and this is a big deal, you have managed your money all this time, but you want to just take it off your shoulders and go to a big investment company or a private advisor, and you just give them the money. And maybe you've got a non-retirement account here that's got 100,000 or $1 million or whatever. If they want to transfer that into the managed account that their company does, and their company says, here's all the different funds you're going to own, they're going to sell everything you have possibly, and you're going to be stuck with a tax bill in April. So if you work with any institution or advisor, make sure that he or she is very aware that you don't want anything sold until they've done a tax analysis and has conversation with you and say, well, we can sell these funds that aren't going to hurt you too bad. These other funds that are going to create 5, 10, 20, 100,000 capital gains, are you able to pay the taxes? Or we would never sell these others. But I've heard of clients that have gone to the big wirehouses and the huge names that you see on television. The advisor just put them in a bucket with everybody else, and everything they owned was sold and bought everything new in the bucket or the portfolios that everybody else owns. And now you get stuck with a huge tax liability. That's one benefit, that if you decide not to do it or you don't have a family member, if you have a local advisor that's well respected, has a history, you've checked them on broker check, and they're a fee-based advisor that has a fiduciary responsibility, then before they sell something, they're going to want to know what the cost basis of that stock, bond, or fund that you have in your old account. We transfer it over into the new account, but we don't sell it until we've confirmed what the potential tax liability is, and then discuss that with you. Because again, not selling could be a bigger mistake if the market crashes and you need cash. But you don't want the advisor or the company making that decision for you. They should be hands-on and working very closely with you. Every advisor, if you work with a professional, must show why he or she needs to reallocate the funds or leave things as they are. So if you choose to work with somebody, they should justify why they allocated a certain way based on their original conversation with your liquidity needs, income needs, and risk tolerance throughout the market. That will determine where you are. Now, remember, we talked about beta, historical risk. Going forward, we're hoping that whatever beta we settle on, 0.5, that might mean that we have half the future risk of the market, not a guarantee, but market's down 13, our portfolio's okay, down 6.5. That's reasonable. We planned that out. It's not guaranteed, but it's reasonable at that point. We looked at the standard deviation and we have some idea of where we are. Your advisor, if you work with them, should be asking all these questions, create a portfolio that works after the fact when the market tanks. At that point, they should contact you saying, Joe, guess what? What? You're down 6%. What? That's horrible. No, the market's down 13. It makes people feel better, and knowing that you have maybe 40% or half of the portfolio that didn't drop if you had an emergency liquidation need or you needed income. And when they reallocate the portfolio, they should also justify why they're doing that. I'm getting rid of this fund and buying that one, and here's why. Now, the advisor on a fee basis doesn't earn a commission when they sell this and buy that, but we don't want them churning the account and gambling on, gee, I think the market's going in this direction. There is reverse churning. We shouldn't be with advisors that don't do anything and charge you a fee every year. That's against the rules too. So we're required to make a trade or two in the next year or two. But since we are required to have activity, then the advisor should be looking for what would benefit you. Oh, gee, here's an old American fund. I didn't want to sell it in their non-retirement account because of the taxes, but I hear that American funds are coming out with exchange traded funds. They might let us exchange into it, avoid any tax liability, and get into a fund that's more tax efficient with lower cost. That's my job. Or intermediate term bond funds were paying good yields before, but I think interest rates are going up. I'm going to sell it because you usually don't have much capital gains in bond funds. I'm going to buy an ultra short term or short term and get ready and be in the storm cellar when interest rates go up. Those are the things we should be doing. Or maybe there's a new exchange traded fund that does manage the downside on the share price when interest rates go up, and I can get rid of that old 0.80 managed fund. We do that on a daily basis. I'm always researching funds, or you should be researching funds. They should be doing something, but not timing the market where, gee, I'm going to move here and we're going to gamble and make all this money. No, we need to reallocate for lower expenses, maybe better management if they're managed. Or someday when there's a digital currency index fund, we go from a digital currency managed fund, they're not available yet, that has a high expense ratio down to an index fund. When I say they're not available, there are funds that use Bitcoin, but not a digital Bitcoin ETF yet. But I'd rather start off with a manager and then go to an index once it becomes very well known and there's a lot of money there. Remember the daily, weekly, monthly, quarterly, biannual, annual. So you're either getting excited about, yes, I want to do this. I have something to do now in retirement, or you're going, oh my gosh, that's just too much. I'm going to let my partner, spouse, son-in-law, advisor handle it. Well, if they read this book, it's not that you have to do these things, but if you knew, prepared a little bit for what the Fed's telegraphing, you could be prepared to reduce the loss on your bonds. Weekly, if you find that you did have a managed fund and the manager's leaving, maybe you move to another one that the manager's been doing it longer, just in case. Monthly, you're shopping and found some better funds to replace the ones that you don't like on a quarterly basis. Biannually, you're forcing yourself to sell off one of those sector funds. It's just up way too much. One of these days, energy is going to tank and you'll have wished you sold it if you had them. Then maybe you would have sold off technology that was up so far, 6 months ago or so. Enforce yourself that if something goes up more than 25%, I'm going to sell part of it. Then annually, you're reconfirming your financial planning, your portfolio construction, and then you restart the process all over. Now, some other things that if you do hire a CPA or an advisor, they can also help you do Social Security income planning. So they all do classes on that, either online or in person. If you have a living partner or spouse that you're legally married to, how does that affect the other one if one of you die? There's a lot of little podcasts you can go to. Charitable giving, if you want to do that, there are donor advised funds where you can invest into those funds, get the write-off, and let somebody else manage those. Or you can out and out donate money out of your IRA. All that stuff needs to be researched either on your own, or the advisor should know that you can or can't do it directly out of your IRA. And what's the maximum amount I can donate out of the IRA for the distributions I'm supposed to take. All that stuff changes all the time. So go back to it and check things out. Health savings account, investing and distributions, and 529 plans and all that kind of stuff. So if you were to work with somebody, or at some point you're too tired because my son is entering my field and getting all the certifications and everything, but 15 years from now, I'm going to say, you know what, you handle it and take it all. And hopefully he'll be in the practice and taking over the practice. But I don't want to be bothering with it because I want to travel. I can see the end of the road coming. I'm not getting any younger. So I want to go do my bucket list, travel, or do other things. I have a client that's 78's flying out to Philippines and is going to go scuba diving 100 feet down. A little risky for most of us, but that's what he wants to do. So if he doesn't want to be managing his money and he hires an advisor, here's an example of average fees. I'm not saying this is what you'll pay, but depending on how much money, if you only have 500,000 or less, you might be paying 1.2% per year or 0.10%. I always like to say 1/10 of 1% a month. Or if you have more than that, the next 500 to 750,000 might pay 1% a year or 0.83% per month, and so on. And it gets down as low as 0.45 per year or 0.37 per month on 4 million to 6 million. Well, who's got that? How does this all work in your brain? Well, if a portfolio has $1 million and it's the first dollars pay a little more and the last dollars pay less, your average expense ratio might be 1.1. Now, every advisor has a different schedule. So I'm not saying that this is going to be true for everybody. If you walk in with 4 to 6 million, I'm sure you could negotiate a lower cost on the first dollars. But I'm just saying these are the different grids that I've seen before, but some advisors charge more, some charge less. So it just gives you some idea, but it's the group average that you want to ask somebody, look, I'm giving you $1 million. What's my average? And in this particular schedule, it might be 1.1, and it's billed on 1/12 every month, or it could be quarterly. A lot of advisors charge quarterly. I like monthly because it's not so big. It's like quarterly, it's like, oh, that's a big fee. Monthly, it's like, oh, that's smaller. Fully disclosed, it's a psychological thing. And it's a little more consistent. If you didn't want to pay an asset under management fee to the big companies or an advisor, I don't know that I think it's worth it to the big companies. You might as well get a robo advisor online if you wanted to. And I've run those down and their portfolios are not that impressive. The problem is the robo advisor and the big companies are into scale. They're into building the biggest behemoth companies they can. And if you want to go big, you've got to make things more generic and less personal. I don't like that. Do it yourself, have a family member, or hire a local advisor who is really appreciative of the business, not a big company that says, okay, we got $1 million, we're going to make whatever, $10,000 a year, throw it into this account and you never see it. And the advisor doesn't have control. I would rather see you work with somebody local or do it yourself. Some CPAs do fee-based advisory work as well. Hopefully they're into all the details of the portfolios. Some advisors pay for portfolio recipes to put their clients in. I think that's inappropriate. I think the person you're paying to manage your money should be managing it, or what's the point of using them? Why should they send it off to the home office or some outside managers? There were a few advisors that did that back years ago and really regretted it when that outside advisor was Bernie Madoff. They gave it to him. He gave them 10% returns. Everything was easy. The advisor got to keep the whole fee instead of share it with him. But in the long term, look what happens. You don't want to pay an asset management. You can pay them hourly. I don't know what the rates are. I'm going to say average of $150 to $400 an hour. Retainer fee, you could pay a certain a retainer if you're a bigger family setup and have a financial advisor be available whenever you needed them, or a commission, which I'm not sure I like that anymore because you can do a lot of the things by yourself without paying a commission. Some mutual funds, if you buy them on your own, well, we prefer to use exchange traded mutual funds that trade like a stock. So there's no commission for the most part. There might be a $5 trading fee or $8 or something. But we know that Uncle Schwab and Fidelity and TD Ameritrade and all the brokerage houses, when they're buying and selling stocks or exchange traded funds, which are categorized as stocks, they get a spread. So if the purchase price is 10, that's what you pay. But if they bought it from somebody else at $9.99, that's what they pay. They make a penny. Or they might buy it at a much lower price. But if the current sales price is 10 and they bought it for 9, the SEC regulates this. But if there's very little trading, it's possible that they could buy it for 9 and sell it to you for 10, and they make a very big spread. It is controlled. They're not taking advantage of you. Very thinly traded stocks or ETFs have a bigger spread, and the companies charge more because it's harder to get the thing sold. And sometimes the company will have to buy it from you at that $9. And even though if they could sell it at 10, they'd make a big markup. What if it never sells? They're stuck with it. So market makers and authorized participants have some risk involved. So they need some skin in the game and make some profit. But if you have some old mutual funds, if you have old A shares, you paid a commission upfront to buy that mutual fund. You shouldn't be paying commissions anymore when you're reinvesting dividends. If you buy more of it, though, you could be paying 2%, 4%, as high as 5.75, I think was the old numbers. And so adding new money to A shares, probably not a good idea. If you hold good A shares from a big investment company that's respectable and you've got a lot of gain and you don't want to sell it to buy a low-cost index fund, then just hold the A shares. But I wouldn't be buying new A shares because there's all the no-load funds out there in the world that you could buy with new money. But preferably no-load exchange-traded funds that you can buy that we hope have lower costs, although there are new exchange traded funds being created that have massive management expenses. So don't just trust that they're low. Check and see if it is. I would stay with the big company names because, Vanguard, Fidelity, Schwab's not going to take advantage of you. If there's a higher expense ratio, there's probably a good reason. But I wouldn't buy new A shares with anybody. unless it's your grandson and that's all he does and that's where he's getting started and you want to help him out, or your granddaughter that sells you B shares. Those are bad. B for bad. They don't have a cost to get in, but they have a massive early withdrawal penalty in the first year, and it goes down over about 8 years. And then along the way, they're charging an extra 1% a year that will drop off in, let's say, 6 or 7 or 8 years, and it'll convert to A shares. Anyway, if you see an A, B, or a C, I would avoid those. C shares don't have a cost to get in, and after a year, there's no penalty to get out. Within a year, it's only 1%. But the C shares are going to have a higher cost by a half, 3/4, or 1%, and they pay the advisor by way of that higher cost. Now, it's not a bad thing if your advisor only sells you C shares. The only problem is there's not enough of them that have a low enough expense ratio plus that part they paid the advisor. In my opinion, it's just not worth it. In the old days, when we wanted to go fee basis and we weren't quite ready to do contracts with clients, a lot of advisors would go to C shares, and it made it less painful. It was less scary. But if you're an advisor out there, I highly recommend you start transitioning to hourly contract percentage or whatever ways you want to get paid. But it's okay to talk about how you're going to get paid because you're doing the work. If you use an advisor, obviously the reputation should be great. They should absolutely never pressure you to do anything unless it's April 13th. You got to do your IRA contribution. Fee-based advisors and hourly and so on, they have to act in your best interest. So when they do the allocations, they buy or sell, they need to put notes in the file to show why they did that. And it should absolutely be in your best interest. I would stay away from the big companies that have their company name on the door and they put you in their company mutual funds that are not exchange traded funds. Big mistake, because one, they're charging you a fee. Two, they're getting a fee on the funds that they're putting in your portfolio. They're double billing. And for retirement plans, that's been cleaned up and they can't do that, but non-retirement plans, they can. So watch out and make sure the company doesn't put you all in their funds. A sprinkling of them, if there's a reason, sure, they're going to get 25% of the funds of your portfolio in their company funds. And if they're really good rated funds and low cost, that's okay. But you really want to watch out. If they're mutual funds, they're not low cost exchange traded or index funds, because they're getting paid part of that fee as well. They're paying you a cost to manage it. And why do you want to pay a fee to be hustled into their funds? That's really inappropriate. Never work with an advisor. You haven't done a background check. We mentioned that. Here's the numbers. Hopefully these are correct. Check the background, brokercheck.org. And if they're a fee-based advisor, it'll direct you to the SEC website. And sometimes you might not be able to find everything about the advisor's company. If they go through, maybe I'm an advisor, and if I use Schwab, then you're going to get Schwab's registered investment advisor information. But do look up the advisor to make sure that they don't have any background problems. I always joke that I know what it's like to be in jail because I was a reserve deputy sheriff. That's how I paid my bills, as I worked at the main jail and the county jail, and sure wouldn't want to go back. Don't want to have to go back there for pay anyway. But some advisors, if they've been arrested for things that are not related to finance, petty theft, drunk driving, not paying their taxes, you may find advisors out there that have things like that in the background. It's possible even a good advisor could have a complaint. I don't have any, knock on wood, but somebody could say, I lost money and it's all your fault. And I need to have a lot of notes saying, here's the risk. And that's why I like the clients to know what beta is and standard deviation and expenses, because I don't want to have somebody that could come back and file a complaint. Fortunately, I haven't. But other advisors, good advisors, have had a few complaints, especially if you went back to the old limited partnership days and you had a disgruntled advisor or client that lost money. But do check their background very, very closely. You should avoid unlicensed activity, an advisor that's doing something they're not specifically licensed to do. Unlicensed securities, obviously, we're not going to put clients into direct securities with somebody in a garage somewhere coming up with a new computer. It's just not allowed. you could go do that on your own, but we don't do that. That's why people like hedge funds. But hedge funds are so highly expensive, it's not worth it, in my opinion. Unauthorized trades, if you have an account where somebody does not have discretionary authority to do trades, if it's just a brokerage account, they need to have a verbal confirmation that it's okay to sell this and buy that. And especially fee-based brokers, the dishonest ones will do trades without authorization to generate commissions. I would like to hope that doesn't happen anymore, but I watch American greed and it does. So it's unfortunate. But unless it's a managed account where you're charged a fee and they have discretionary authority to do what's right for you, for example, get out of intermediate term bond funds and into ultra short term because I'm concerned interest rates are going up, yeah, that's okay. But unauthorized trades in a brokerage account is outrageous at that point. Unsuitable recommendations, things that don't suit your risk tolerance, would be inappropriate. If I were to call and say, hey, I just bought a bunch of stuff in digital coins. Well, if it's extremely high, more than like 2 or 3%, that would be unsuitable and it would be too high of a risk. And that would put me at risk of getting a complaint, losing my license, or something like that. So whoever helps you, or if you do it, obviously you want to make sure it's suitable for your situation and condition. Tax deferred redundancy, your IRA shouldn't have municipal bonds in it. IRA should not have tax deferred annuities in it. That's a big one. There's always an annuity salesperson out there that wants you to roll over all your stuff into their rollover IRA and then sell you a bunch of annuities that they might in fact be getting 2, 4, 6, 10% commission up front. Right now, annuities don't pay enough to make it worth all the fees. The only annuity I know that's worth it is Social Security. I wish we could buy in and get money if you live too long. That's one of my recommendations for the government. But other than that, annuities for the most part, especially now, are not going to be viable, in my opinion. Account churning, buying and selling, reverse churning, not doing a damn thing. Ultimate trades, untimely trades. They shouldn't be buying something when it's peaking and selling when it's dropping a lot. That doesn't make sense. Unauthorized transfer of assets, absolutely. There should never be anything coming out of your account other than 0.1% a month fee, or an RMD that you authorize to go to your bank, or anything else unless there's a court order. So congrats, we made it. I just want to mention a few things just to get you started. I'm going to go over to Morningstar in a minute. But when you are done today, I would like you to go to 199. And there are questions here that I want you to take this test. And then on another page after that, you'll get the answers on page 207. One is, what's the responsibility of a fiduciary? A, to sell you the most popular investment. Oh, that's cool. Let's go buy GameStop and all these other crazy things. No, that's not right. To invite you to a complimentary steak dinner and seminar. Oh, there we go. I've seen some of those flyers, glossy flyers, make you salivate. Some of the most incredible looking steak or salmon, but obviously they're spending $3,000 to $5,000 to feed these people. Guess what they're going to want in return? And unfortunately, it's not just to get you in to do fee-based advisory work like a CPA. It's to sell you things they get a quick upfront commission. And sadly, to the advisor, they're selling out their own futures. Take a little dribble of income over your lifetime. It adds up. Why sell products that are not good for people? What does beta mean? Oh, did I finish that? What fiduciary responsibility? It was the right answer is to put your needs and best interest first. The next one, I'm just going to go 3 of these, but what does beta mean? The historical return of a fund, or the fund and the portfolio's market risk level, or price indicator. As you know from this class, it's the fund and portfolio's market risk level. Last one, number 3 out of 25. What is standard deviation? Average bond rating, historical market trends, or historical fund volatility measurement, and it would be C, volatility measurement. So we've got all these things here that are pretty cool that if you can answer them all after reading the book, and you should be, I would say you're ready to do some of this work on your own. But there's nothing wrong with not wanting to do it. Let's see if I can drag over a screen here. Hopefully you can see this screen. And this is the Morningstar screen. I'm going to take a look at some model portfolios. Now, we have them that range from ultra conservative income, balance, growth and income and growth. When you go to work with somebody, if you hire somebody, a big company, they ask you, are you a conservative investor? Are you moderate? Are you growth? Are you I have no idea what those mean. As we'll see, we can change the holdings in a balanced portfolio to make it more or less historically risky. Historically risky, not in the future. I don't have any idea what's going to happen in the future. Remember, back in March of 2020, the low volatile, high dividend stock funds dropped more than technology funds. What? That was because we feared that the companies would stop paying dividends because they had to be shut down. That's like you buying a herd of dairy cows that you learn the next day will never produce milk. Well, the price just plummeted. But those funds did rebound and do quite well after that relative to the risk. But please, please don't listen to me or anybody else that attempts to tell you what the future volatility will be. I can only tell you what it might be based on the past with no guarantees of the future. So if we look at some of these portfolios, let's take ultra conservative. We have a variety of funds that range from short-term preferred stocks and convertible bonds to low duration bonds, ultra short-term bonds, variable rate preferred stocks, 0 to 5 year investment grade bonds, 1 to 5 year. Are you getting the theme here? These are all very short-term, very conservative investments. So don't expect a lot of return. Let's take a look and see. This might be a fund that you put your parent into or something. When we look at this ultra conservative fund, it's not going to be real exciting. A lot of it is bonds. And because interest rates are at risk of going higher, we can't afford to go 30-year treasuries and get 2.5% because if interest rates go up, the treasuries could drop 17% if rates go up another 1%. So we're mostly in bonds, but these are usually ultra short-term or short-term. And then there's some cash mixed among the funds. So bonds, 67, cash at 10, 77, 78%, very little stocks. Now, why would stocks be in an ultra conservative fund? They take the edge off the volatility in the bonds. Sometimes stocks will go up and bonds will go down. So they'll help average that out a little bit. It's kind of like the rock that breaks the wave. Takes the edge off it a little bit. Studies have shown that if you had all bonds, you would have done a little bit better if you added 10 or 20% of stocks at that point. Here, we have very little stocks in there. Most of them are big company stocks, large. And then the bonds, we have limited term and moderate, but most everything is very short term. That's investment grade and then AAA and that. And then these are moderate term, a little bit longer term maturity, but still investment grade and so on. So here, the blue line represents the New York Stock Exchange Broad Market Stock Index. These are stocks that aren't reinvesting. They're just stock values. And they've been way up and way down. That would have been too stressful for your parents. And they went way up, but your parents don't care. They don't want to see a lot of volatility. You had some here in March of 2020, some here, but not very much compared to the overall markets. But of course, inflation is going to eat away. But if your parents aren't going to live long, then that's not as much of a concern. Worst case scenario, in these from January to March, this portfolio only dropped 5%, whereas the overall stock market dropped 38% briefly and had a downturn average of about 17%. So we're down less than a third, let's say. So I can't guarantee this number going forward, but at least I get an idea of how it's reacted in the past, kind of like a crash test. Here we have Cohen & Steers, which is a low duration preferred stocks. That's a specialty fund. So I'm assuming their management fee is higher. Fidelity low duration bond factor. So they might be a little bit higher expense because they're managing bonds to keep their duration or maturity low, keep us from losing too much. Invesco ultra short term, lucky if we earn 0.5%, but if interest rates go up, we don't want this portfolio to lose. So we're not going to get a lot of return on the portfolio. Conservative allocation, moderate. Jenny Mays, they're probably down 3% now, but over the long term, the AAA rating helps us feel better when we see the credit rating of the portfolio. Vanguard Lifestyle, pretty conservative. These are like target funds, and then 0 to 5 in bonds. And the balance fund here is my heartbreaker. I've been saying for a long time, I love the balance fund, but the half that's in bonds are long-term bonds or intermediate term, and the other half is in technology. Done really well until recently that technology is down and interest rates went up. Now the bonds are down. So that fund's down like 10% as of March 15, 2022. But you might hang in there if you have that fund, because the technology funds might come back and make up for the bond decline. But that was something I've been talking about for years in this class. I love because its expense ratio is 0.07, but its duration or risk of loss if interest rates go up was like 7 or 8. If interest rates go up 1%, the bonds drop 7 or 8%. Mathematically, in a calculation, not a guarantee the public will react that way. Okay, so standard deviation, this is 3 years, 5 years, 10 years. So our standard deviation is only 3.61. That's pretty low. So your parents are going to feel fairly good if they look at it. Whereas the New York Stock Exchange Broad Market Stock Index is 13.42. So that makes us feel a little bit better. But our average return in this portfolio over 10 years was about 7.23. And I think the stock market we were 4.22. That makes sense. And the stocks were up 7.23. So we didn't earn as much there. Then when we look at the beta, remember beta is how volatile are we compared to the index we're comparing ourselves to. We're comparing ourselves here to the New York Stock Exchange. So our beta is not 1.0, the same as the exchange. Ours is only 2.23. So we're less than a fourth of the risk of the overall stock market. So if the stock market drops 10, we should maybe drop 2.5. Stock market drops 20%, maybe we'll drop 5%. We don't know, but we know ahead of time that historically our risk has been about 1/4 or 1/4% of the overall broad market stock index. No comparison to the S&P, which is a lot of technology stocks. Now our alpha is 1.90. What the heck does that mean? Well, given our portfolio is about 1/4 the risk of the overall stock market, how much value have we earned more than average portfolios with average funds, meaning higher expense funds, managed funds? We've done a good job of getting the cost down. So have we done better than the overall stock market? And yes, we have. This portfolio, if you held the exact allocations, the performance over the last 10 years would have been 1.9% better than a normal average allocated fund that was ultra conservative like this. And so this is what I'm trying to do is, this is what you might get when you walk into a regular company that sells its own mutual funds and puts you in these managed funds that don't include the low cost broad market index funds or the specialized allocated multiple index funds with ETFs. They're not looking for saving the cost. We are. So we earned 1.9% better per year if you have the same allocations. Effective duration of the bonds, 3.77. I'd rather it be shorter, but we've got to get some kind of yield. And the volatility historically hasn't been too bad. But because we're not going just for the distribution and income, we just want to be stable and safe. We had to up the duration slightly to get the Jenny Mays. They're AAA rated, so that helps us with the rating. Because here's our bonds. Triple B is investment grade, single A, double A, AAA. We've got really good rated bonds, but the higher we go, the lower the yield. And if we have managed funds managing the triple Bs and below, the expense ratio is going to be a little bit higher. But we can go out for a little bit longer maturity, 6.6 years. But if we didn't want to have any risk of interest rates rising, then we would have like 3 years of maturity, and duration might be 2.5. Expense ratio 0.19. Does anybody remember why the average expense ratio is 0.2, but we're getting 0.19? Are they just giving up their management fee? They giving money back? No. Remember, in the exchange traded funds, they can do what the brokerage houses do with your stocks. If you had a bunch of Apple, the brokerage company, without telling or getting you your permission, can lend your Apple stock out for somebody that wants to sell it at, I don't know what the price is, call it $100. And then they think it's going to drop. They buy it back for 50 and they give us back our shares. Our shares went from 100 to 50, but we were a long-term holder, so we're going to hold Apple for a long time. The brokerage company can make money off renting out your individual shares. Now, if you have exchange traded funds, the brokerage company doesn't do that with those, but the internal managers, the company managing that fund, can. But they don't keep the profit for themselves. They reduce the expense ratio by the profits they made. So if you have exchange traded funds and they're passively or aggressively managed, they might, and there are several out there that will buy the NASDAQ 100 and sell calls or puts or whatever they do. And their yield could be 7 or 8%, but there's pros and cons about that. So be careful if you have a fund that does options. Be very careful. Learn what you're doing first. There's a big list of all of the funds here. They're all listed, some of them twice. But we want to make sure, as we recall, we have different company name brands in here. So we have Vanguard iShares, Invesco. Invesco is a smaller exchange traded company that does different things than the big issuers because they're trying to start a movement or come up with a thematic fund. Vanguard, Fidelity, Schwab might not want to bother with these new little ideas until they get big, and then they'll walk in, start their own fund and take business from everybody else. But we do want to have a variety of different companies like we've mentioned before. So let's see if we can do this correctly. I always have a habit of coming out of something and then canceling everything. Okay, so now let's see if we can go to another portfolio that is different. Instead of ultra conservative, let's just go to the other spectrum just in case we ran out of time. This is a growth portfolio, has a variety of funds in it. And you'll see, again, different companies. Fidelity's in there, Schwab, State Street, we call Spiders, TD or T. Rowe Price, and JP Morgan, a variety of companies. We don't have time to go over each one, but this is a growth portfolio that when you're working with an advisor, we tend to be a little more conservative than most growth because we get a lump sum. Here's my 401k, here's my thrift savings plan, roll it into a rollover IRA. Here, Bill, there's all my money. Well, I don't want to risk losing the money. Today, I'd be leaving it in cash and buying in over 3 to 6 months, just in case. We don't know where the market's going. Never did, but we just feel concerned now. But I would rather be super allocated among a variety of growth funds in this objective, but aren't extremely volatile or risky. Like, I don't want to be in something that could lose things permanently. We can be in growth-oriented stocks that are going to go up and down. Okay, so here's a growth portfolio. Some people would argue that it's growth and income, but and it does say growth and income. So growth and income growth. Let's see what we got. Here's the portfolio. Obviously, it has US stocks of 77.5, let's say, non-US of 8. So we're up there, 80 some percent, 85 or so. Other could be preferred stocks and convertible bonds. And then you have a small amount of bonds. Now, just my opinion, if you're going for growth or growth and income, I would always leave some money either in cash. Today, cash would be fine because you're not going to earn anything, or bonds, just to keep some powder dry. So if the market does collapse, you can move money back in or pull money out if you need it. But generally, those of you that are very aggressive, you've got a big pension, you've got more money than you need, I'm investing for the kids, then I would still keep 10 or 20% of dry powder just in case you need to move it back in or something comes up. I'm just saying. There's always some sector of the market that drops a lot, and it's a good idea to buy in when it's down. Mostly large company stocks, average volatility 17%, but they're more stable. And if it's your retirement plan, we can't risk losing it because the mid caps are great, more growth potential, but their volatility can be 24, 25%. So we don't want to be liquidating money there if it's a retirement plan and they're down 25 or more. Small caps right now, today, they're only down a few percent, might even be up when the other market's down 13. Well, they're stable because they're non-correlated to large companies. They're not the big companies that people think interest rates are going to affect. Interest rates are going up. Big companies aren't going to be borrowing at cheaper rates, and they're not paying as much as whatever. There's always some expert that tells you this is why everything is where it is. We're looking into the future. We don't know what that's going to be, but I can tell you historically, small stocks have a history of about 35% volatility. They happen to be non-correlated and allowing us less volatility when they have a bad day are more volatile. So we don't want to run over to small caps saying, they're non-correlated compared to the overall large company stocks. I'm going to buy those. When they have a bad day, they have a real bad day. So be careful. Add them in there to take a little edge off it, like we do some of these other positions, but don't count on it 100%. Now, if you just paid off the house and you've got an extra $1,000 a month, sure, you could buy into a small company or small cap growth fund. They're down and buy a little bit each month and average out the highs and the lows. And you might turn out to do pretty well in your late retirement. Or that could be an account for the grandkids. Get a nice little small cap growth index fund, very tax efficient, buy into it each month, and then gift shares to the grandkids when they go to college. If they don't go, they're your shares. If they do go, they might not be paying any capital gains tax when they sell the shares that you gifted to them. Bonds, low grade, short-term junk bonds, but we have a manager probably managing that fund, and there's a very little. These things will tell you what areas of the economy, what sectors, and then these will tell you which countries. Just before the Russia crisis, a lot of these economists were saying you need to be in emerging markets and foreign. And that is true. I wouldn't disagree because there's more growth potential with those companies there. Maybe US stocks are overpriced. But when there's a war beginning in Ukraine, all of a sudden the market starts falling more for the uncertainty. The stocks that are here in the US might hold their value a little bit better than if you're in Europe and have worries and tensions of controversy and war. So, but now maybe they start to settle things out, things stabilize a little bit. I don't doubt international, global, and small cap stocks are good buy. The reason the internationals are good is because you pay a lower price for the dividend you get. So the price earnings ratio or the multiples are a lot better, but they're not as stable. But if you're willing to take some volatility when something scary happens for the lower price and the higher dividend, internationals look very, very good. I'm starting to shift a little bit over those, but what do I know? Maybe there's another conflict in the Middle East or something happens. So we do the best we can in allocating the portfolio. Now here from left to right, this is our portfolio on the yellow line. And the New York Stock Exchange price per share is right here. This is not reinvesting, just the share price of what's in New York Stock Exchange in and of itself, the appreciation. And this is ours, and I'm assuming we're reinvesting. So I'm going to just assume New York Stock Exchange will probably be up there with us. But I'm assuming we have a little bit less volatility, not a lot, but a little, because we're more diversified. Worst case scenario, this is a growth portfolio. We were down 19% January to March in 2020. The stock market dropped as much as 38, but its average probably would have been 25%. So we're not quite as volatile, but we definitely have some volatility there. So if I'm creating this portfolio, you or your advisor needs to do a portfolio that they know these numbers. This new portfolio that we're proposing to you, we need to know what the history's been. It's not a guarantee, but we need to know. It's like if you go get a dog at the shelter, has it bitten anybody before? Or is it okay when you pull its ears? We don't know, but I want to have some idea. And in this portfolio, unlike the ultra conservative that was only down 5%, this one was down 4 times as much. That's okay with me if I'm looking for growth. Left to right, this chart, scatter plot, low volatility, none, then low, then moderate, then it gets greater. So we're here at about a historical volatility of 10% for the last 10 years. And our return has been about 10%. So volatility 10, growth 10, that sounds like a pretty good deal. The New York Stock Exchange volatility is 13% and its growth has only been 7.23. I'm assuming if they reinvested dividends, it would be about the same. But we want to be as far left, lower volatility, and as high as possible, higher return. And so we're in pretty good shape. These little green dots are the funds within our portfolio. We have one here that's way up in return, but it's very high risk, relatively speaking. This one has negative risk, and it's got almost no return. That's probably an ultra short-term fund. Then we take a look at some of these others. Standard deviation, average volatility for 3 years is 14% for us, 18% for the stock market's broad market index. 10 years, we've been 10.66 versus 13.42. So we're not as risky, but we have in the last 3 years, 80% of the risk for 3 years and 79% of the risk for 5. And then going back 10 years, 77% of the risk. Now, here's the cool thing. Because we picked funds that had extremely low cost, and the only funds that we paid a higher management expense, I hope have given us a better return than others like it, then this gives us a really high alpha. Average standard deviation to a mixture of thousands of other portfolios with the same alpha, we come out 5.15% better per year than the average portfolio with the same beta. So alpha is good. And what does alpha mean? It's giving return in excess of what its category is. Now, you don't want to go buy something that says they have a lot of alpha, because in most of the funds, it has alpha only because it's the opposite of the market. Right now, let's say gold goes up and the alpha shows a positive number compared to the stock market. That's fine. But going forward, gold may go down and the stock market may go up. So you add alpha by being different than the other funds that are similar to it. These you can go in later and just see. We have more higher yielding funds here, whether it's stocks or bonds. And there's a price to pay. If interest rates go up massively, the high dividend funds may fall. Now, they haven't fallen much recently, which is kind of weird because people are worried about interest rates going up. But then the Fed says, oh, wait, maybe we're not going to raise them as much. And the growth funds like technology and all of that are going to fall in value are starting to rebound a little bit, but the fear of conflict makes people think, I don't want growth funds with low dividends. I want dividend funds. So at least I've got some income, even if the share price drops. So we have high yielding funds here, but they're not without share price risk if interest rates go up. But most of us that are 10 or 20 years away from late retirement, meaning when I'll be 100 or 90 years old, I'm going to reinvest all those dividends. So even if the share price drops, it's not a problem. But we can predict that if interest rates go up, bonds drop in value. So we're moving to short-term bonds. We can't predict that as much with the stocks. So if you have a high dividend paying stocks, or sometimes you'll hear somebody sell the concept of, I'm only going to buy high dividend stocks and funds, and I'm so smart. Well, it's a little late now because they've been priced up, but if interest rates go up a lot more, they could fall. So you want to spread them around the portfolio and just be aware of that. We looked at the bond ratings. We have a tiny bit of bonds in here, so the bond ratings really aren't a problem. And we have a managed fund probably that handles any of the lower junk bonds in there. There's a small amount of 16% AAA, which might be in a portfolio, and it may be Ginnie Mae's or something. Duration's higher, meaning the risk of the bonds dropping if interest rates go up, but we have a very small amount of bonds and we have them managed. Now, here's the expense ratio, 0.20. That's pretty good. If we didn't have any managed funds whatsoever, then that expense ratio could be 0.10. Let's take a look at all of the funds and see. Usually, but not guaranteed. ETF, that's a fund. That's a fund. That's a fund. Let's see if we have more. Some of these are ETF. Oh, here, it's buried in there, ETF. So a lot of them are ETFs, but like T. Rowe Price isn't coming out with ETFs as aggressively yet. I don't know. I think they have a handful. So we're still using some low-cost funds, but here's another ETF. Cohen & Steers is an actual fund. Vanguard and Fidelity and Schwab, if you actually use the fund, they're probably pretty low expense ratio anyway. So that's not a problem, but we're down to 0.20, but we have a lot of ETFs in there. And as time goes by, we'll be doing more. Some of the other benefits of an ETF is that you can put a stop loss, a limited stop loss, all these things you can do with stocks if you want to try to control the outcome if you think the market's going to go down. Here's SPDR, S&P 500 growth. So what does that do? Well, that fund's going to buy more technology in the S&P. Now, recently, you'd be disappointed because it's probably down a lot. But if I was going out tomorrow saying, look, I've got everything balanced, I've got all my conservative stuff, where's the next upswing? Well, the part of the S&P 500 that represents growth, mostly technology, is down a lot. The NASDAQ, which fully represents technology, is down 20% or maybe 18% after today. So you could go into SPDR spiders. I would use them only because it's a different company than Fidelity, Schwab, and Vanguard. It gives us diversity. We don't want to have all our eggs with one basket in case one of those companies got hacked. Now, when we've got a brokerage account with Schwab, TD Ameritrade, Fidelity, National Financial, and Vanguard, and so on, that's that centerpiece of holding all the data, but the actual money at these funds, I don't want all my money with one company. So if I can find an S&P 500 fund that is just an S&P 500 fund, even if the expense ratio is just a tad bit higher, I'll go with it because I don't want all my eggs at Fidelity, Vanguard, Schwab. Who knows? They could be a target of some hacking. And if they get locked up for a while, I want access to my money. So that's could be laughable. Bailey, what's your problem? Put all your money with one of those companies, but you don't get any expense ratio breaks. There's no reason not to. And in a brokerage account, you can go to Schwab and buy their competitors. Now, if you buy a competitor's regular mutual fund and that competitor is not paying to be on the platform, they might charge you a transaction fee. So that gives us an idea of what the allocations are. So just remember that if you set up a portfolio or your advisor sets up a portfolio, the real determinant of risk is beta, historical similarity to whatever exchange they're comparing themselves to. R square, if they're 100% exactly the same as the overall stock and bond market, that's fine, but I'd like to be a little less. I'd like to be down at 95 or 93% similar, because if one part of the market falls, I want to be non-correlated. Now, what's non-correlated? Well, real estate right now tends to be a little non-correlated compared to tech stocks or the S&P 500. That's good. If the S&P drops, maybe my real estate fund doesn't drop or doesn't drop as much. But if we have a crash, then the real estate fund, everything's going down. The non-correlated is not going to help you. You really need negatively correlated things like gold, Bitcoin, I'm told, or treasury bills. Those three things, I don't know about digital, but gold and treasuries have held up when there's a big calamity or a huge crash. But that only happens once, maybe 5 times in 10 years. How do you know how often that's going to be? So the non-correlated would be real estate, maybe utilities, possibly. They go up and down like anything else. The funds or the stocks in the funds that are different than the S&P 500, those are non-correlated. But negatively correlated would be ones that are absolute opposite, that they go their own way. And when the market tanks, you love them. When the market's up, you don't love them. So keep that in mind in determining what your beta is and how much risk you have. And then do look at the historical standard deviation. That is just a feeling of a rolling average. There's never been a time where this fund's up 9 10.66 and then down 10.6. That's not how it works. It's just an average. And there's some YouTube videos on how to calculate standard deviation, how to calculate all these things. They'll blow your mind. I get on and watch those things, and I just like to learn more. But if you're not into it, we just come back to the advisor telling you, here's the bottom line. You go to an advisor and you're going to invest with them. They're going to manage your portfolio and do the financial plan and the estate plan and the monitoring all by themselves or within the office, not send it out somewhere else. They need to ask you what your risk tolerance is, but you don't know. I don't know what that means. Standard deviation doesn't give us any consistency. Beta gives us some consistency, but we can't guarantee it. So the advisor asks you, look, if you give me $100,000 and I invest it through no fault of my own, the market tanks 10%. Are you okay with your 100,000 being worth 90? And the eyebrows go up. Yikes, not really. Okay. Same scenario. You give me $100,000, I invest it, and the market drops 10%, but you're only down 5%. How do you feel? Well, yeah, I think I can tolerate that. So then I go back and I come up with something more similar to a 5% standard deviation and maybe a 50 basis point beta. So that would give me a little more range of what you're comfortable with. But the bottom line is to the advisor, look, they can't guarantee that you will be up or down at any amount, but they can get some idea of how to diversify the portfolio and look at, when I put it together, what of these numbers came back. If you told me I can only take 5% objective risk, which it be maybe more or less, then I'm going to try to get standard deviation down to 5 or 6. And I'm going to get beta down to 5 or 6, and I'm going to keep reallocating the portfolio until I get there. And then I check with the client and say, look, I've got you at these numbers, but we gave up some return because we're so cautious. So instead of getting whatever it says up here that your average return was 11, this portfolio averaged 5 or 6. Are you okay with that? Yes, inflation, not recently, but historically it's been 2 or 3 or 3.5. I'm okay with that. So in my humble opinion, if I'm creating a portfolio or you are creating a portfolio, let's look at liquidity needs. When might you need some cash or some emergency fund, or what part of the portfolio can be left totally alone? And then at creating the portfolio, how much risk volatility do we have? Do we have a lot of cash at the bank or in the portfolio? Now I'm going to open it up, and I talk very fast, so you need to ask me some questions if you have any, because I'll go back on super fast mode. Did I skip over anything too fast for you? Each of these slides that we've shown are in the book, so you can go back and do that. But if you're a non-do-it-yourself, read what advisors should or shouldn't do, what way they're paid, and hire somebody. I would make sure they're a local person who's going to actually do the work. If you're a do-it-yourself, follow the process every step of the way and look at the portfolio. I'm not sure where you can go to get the same portfolio I've got, but I'm happy to work with you and maybe run a portfolio once, not every week, but help you and say, here's what you've done. And then you go off, set up the portfolio and do what you want to do. If you go to one of the investment companies up to the front counter, they're going to want to assign you to an advisor who charges a fee that's has a high license level or credential. But if you can do it yourself, you can either go online, but we do want you to do a portfolio analysis. Find the funds that are the cheapest and or the best that fit your portfolio, then allocate it to where you come up with these little standards. The book will tell you an average portfolio might have ranges of this. And then if you want to go more or less, you go back and change the allocation. It's just like cooking. You do a reallocation of the recipe, and that will give you a different number. So doing it yourself, follow the list of the daily, weekly, monthly stuff. If you have a partner or a family member doing it, read the book and make sure you have a little bit of awareness to where you make sure they don't make any big mistakes. They might say, oh, I met an annuity insurance agent at lunch today, and we got to put all your money over there. No, not a good thing. If you want to know why that's a bad thing, just Google it or YouTube. We could be here all day where, unless it's a victim of an accident, you buy an annuity and pay them income for life. Any other annuity, in my opinion, in today's world wouldn't be worth doing because of the fees and expenses. You can create the investments that the investment company does for themselves behind the walls of, we're going to take care of you, guaranteed annuity. So that's it. If you have any questions, you can email me if you like. If you want to talk, we can talk on the phone, and I can look over what you're doing on your own and tell you whether or not I would do that. Or if you need some assistance, we're here. Do come back to the class again. However, it's like taking a foreign language. It's a good idea to do it several times. I won't be repeating myself unless you want to watch this class on the website, hunterwilliambailey.com. We've recorded them and you can listen to those a few times. But I have to go over things several times before I get it either, because this is all new. And it's fascinating for me as I get older to learn all this stuff. And if you want something to do, this is it. Or you could say, look, I'm just going to do the investment process. You can hire an hourly fee-based advisor to help you with the insurance and the estate planning, all of that. Hire an attorney over here and you do the investments. It's very doable. You just need to be into it and be like a stamp collector. Love it, live it, breathe it, follow this stuff. ETF.com is where you can look up the some of the more recent ETFs. ETF Prime on the iTunes. Go there and look that up. You can listen to people talking about it. There's tons of podcasts. You can learn everything you want to. If, however, you don't want to spend the time, you just want somebody you can trust handle it, then it's a fee-based advisor that has fiduciary responsibility, who is not allowed to do things contrary to your best interest. So I'm hunterwilliambailey.com. Check out the website. Hopefully we see everybody in the next class, and I'll try to talk slowly, but you got to ask questions. Last chance, questions.
Bill, so if we subscribe on your website, we can sign up for a newsletter, and we would also get notices of your classes. Is that correct?
Yes. Marcia's handling that. Absolutely.
Okay.
And we do, I think it's a weekly newsletter that's timely to what's happening politically and economically. It'll be generic because I got to make sure I don't give specific advice. And then you can email questions if you want to. I'm very happy to help the do-it-yourself investor and free them from people trying to pressure them into managing their money for them. And hopefully they're successful. And I'm also happy to help people that need an advisor as well. But we leave that in your hands. And that's why I've written the book. So you don't feel like you're being sold something. You can go through and do it yourself. Or if not, and you're empowered how to check out any advisor you might work with. Any other questions? No questions? Okay. So we're going to come off here, and the next course we'll take, and we'll let you know what pages to start reading through. But I really think this book will be easy enough for you to read and pick up on the basics of it, and then go on to the podcast. Will be a lot of fun. So anyway, that's it. And when I figure out how to stop my share, I'll close out. Thank you, everyone, for attending. You guys did a great job putting up with me. I talk very fast, but fortunately, you have a reference in your book. Take care. See you next time.
Thank you.